Hi, my name's Richard Ivers and I'm the Portfolio Manager of the Prime Value Emerging Opportunities Fund. In this wire, we're going to go through Prime Value, the organisation, then we'll go through the Emerging Opportunities Fund, how it invests, its performance and some stock examples, and lastly we'll give some details on investing should you be interested. So let's start with the organisation. Prime Value is a multi-award winning boutique that was founded here in Melbourne in 1998, so over 23 years of history. It started as a family office, which is very important because it's very different from most other funds in the market here in Australia. And because it's a family office, it allows external investors to invest alongside a wealthy, successful family who also invest in the funds. As a family office, there's a strong focus on capital preservation. In other words, focusing on risk and downside, not just the upside opportunity. And our core philosophy is building wealth together. Across the organisation, we manage over $2 billion of funds across equities, property, income and alternative assets. Now we'll talk about the Emerging Opportunities Fund itself, the fund that I manage. It invests in Australia and New Zealand listed equities. It invests in companies outside the ASX 100, which is commonly referred to as small cap companies. To put that in context, small cap companies typically are up to around about $4 billion market capitalisation. However, that depends on free float and liquidity. Because we're a family office, we're very focused on downside protection and capital preservation. So we focus on the quality end of small caps. We don't invest in mining companies because we consider them relatively volatile. And we have certain ESG exclusions. So we don't invest in companies that are involved in gambling, armaments, pornography or tobacco. Our style is long-only GARP. By long-only, I mean that we don't short companies. And GARP means growth at a reasonable price. So we're investing in companies that can grow their earnings over the long term and compound our capital, but we have a valuation overlay. So that's the reasonable price element. It's a relatively vanilla fund, so we don't use leverage, we simply buy stocks and the cash left over is held in cash. We invest in 30 to 40 companies in the portfolio and the weighting of those companies is between 1% and 6%, so it provides a good level of diversification and risk management. Now we'll talk about performance. All performance numbers in these slides are 3 years up to April 2021. That's the exact 3 years that I've been managing the fund. And all numbers and performance numbers are after fees, so they're what the investor gets. As you can see by that slide, the performance has been very strong over that 3 years. So the blue bars show the fund's performance and the black bar shows the Small Ords Accumulation Index, which is the most comparable index for comparisons. So performance has been strong and consistent across the 3 years. If we delve a little deeper into the performance numbers over those 3 years, we can see that the returns have been 20.7% per annum after fees for the fund. That compares to the Small Ords Accumulation Index of 9.1%. So we've outperformed by 11.6% per annum. But interestingly, not only has performance been strong, but risk has been lower. So if you look at risk in terms of standard deviation or volatility, the fund is 18.6 over those 3 years. And that compares to the index volatility of 21.5. So the volatility or risk is approximately 14% lower than the index. Another commonly used measure is the Sharpe ratio, which measures risk-adjusted returns. And as you can see there, the fund at 0.76 has a significantly higher Sharpe ratio than the index at 0.35. Coming back to the focus on capital preservation, if we look at the returns and how it performs in up and down markets, over the 36 months I've been managing the fund has outperformed 87% of the time when the index return has been negative. So strong performance in down markets. In months when the index has been positive, it's outperformed 52% of the time. And overall, it has outperformed 67% of months. So strong performance, particularly in down markets. but also strong performance overall. So if we tie that back to some stock examples, two of the larger holdings within the fund currently are News Corp and Mainfreight. News Corp is a global media business. Its largest asset is a 62% shareholding in realestate.com.au, a listed company on the ASX. Realestate.com.au is one of the highest quality businesses on the ASX, with strong pricing power, being the largest real estate portal in Australia. So News Corp also owns Move, which is the number 2 real estate portal in the US, the largest market in the world. It also owns Dow Jones, the publisher of the Wall Street Journal, the leading financial publication in the world, which has a very high level of digital subscription. It also owns a number of other assets within its portfolio. We believe when you value all of these assets individually and sum them up, you get a valuation more than 30% above the current share price. So what News Corp is providing is a high quality bunch of businesses with a relatively low risk, priced very attractively. So that growth at a reasonable price. Mainfreight is another large holding within the fund. It's a global freight forwarding business, and you may see some of its blue trucks around town. It has an incredible track record of 15% EPS growth over the last 10 years compound. Its return on capital is over 20% and is rising, highlighting the strength of the business, and is exceptionally well managed. Another couple of recent additions into the fund have been United Malt Group and NIB Health. United Malt Group is the 4th largest maltster in the world. It takes barley, converts it into malted barley, and provides that to beer brewers and Scotch whisky makers for the production of their products. It's had a tough time through COVID because of the shutting of bars and restaurants, as it over-indexes in the craft space, which is particularly hard hit by the shuts. But now that vaccines are being rolled out in the US and the UK in particular, which account for 60% and 20% of its revenues respectively, we should see a rebound in the opening of demand from the craft brewers. And therefore the outlook is looking particularly strong. But even looking further out, beyond COVID and the interruptions we've had, it's a business that can grow at 10% per annum compound, has strategically strong assets, and we think it's a very attractive business. NIB Health is an Australian private health insurer. Private health in Australia is key to the funding of future healthcare costs and has the benefit of a taxation structure that encourages membership here in Australia. NIB has done well through COVID because membership has been strong as people are more concerned about their health, and costs associated with elective surgeries have been deferred, so profits are particularly high. There's some concerns in the market that these margins are unsustainable, and we agree that they will come down. But when you take a long-term view on the sustainable margins in the business, it is still very attractively priced and well below market. So combined, all of these four core businesses within the fund are very high quality, attractively priced, and should generate strong compounding returns for investors over the long term. In terms of fees, the management fee that we charge is 1.25% per annum. We have a benchmark of 8% per annum absolute. Now this is relatively unique. Coming back to the Family Office Foundation, the preservation of capital focus, we believe that an absolute benchmark is more relevant to the way we invest than an index like most other funds. We're not particularly interested in the index and the composition of it. We're focused on the businesses and what they represent in terms of risk and return. And we determine the 8% per annum because that's the long-term index return. So we believe it's fair for investors and us as fund managers. The performance fee is 20% above the net performance of the fund, above that benchmark of 8%. We have a high watermark with no reset on that high watermark. Should you be interested in investing in the fund, it's relatively simple. We have a retail licence, which means you don't need to be a sophisticated or wholesale investor. The minimum investment is $20,000. Our JP Morgan is our custodian, and we're going to keep capacity relatively small to ensure that we can sustain these strong returns. Should you be interested in investing in the fund, you can contact our client services team. The details are there on the screen. There's also a QR code that will take you through to our website with an online application button in gold that says click to apply. There's also details on the bottom of this wire for further details about the fund and investing. Thank you very much for your time.